Hello and welcome. You're tuned into this special edition of Mutual Fund Corner. I'm Sonal Bhutra, and in the Mumbai News studio today, we are going to talk all about individual mutual fund queries. So we asked you to write to us, maybe on social medias and email to us as well, and we've got a lot of them. And joining me today on the show is Mrin Agarwal, financial educator and director at FinSave India. She's here to answer all your individual queries. Mrin, good afternoon. Thank you so much for joining us, and always a pleasure speaking with you. It's after a long time that we're speaking to each other. It's good to have you on the show. But let's not waste any time because we have a lot of queries to talk about as well. So let's get it started. Rajiv Rath is writing to us from Mumbai. He's been investing in mutual funds for quite some time now. He's been investing around 20,000 per month in funds like Quant FlexiCap among PPFAS, FlexiCap. There are others as well. The list will come up for you in just a bit on the screen as well. He says he's planning to retire at 45 and has 1 lakh rupees to invest every month. Wants to know how he should invest his money. Well, it's a very specific table that is there for us on the screen as well. Mrin, tell us what do you suggest Rajiv should do? Of course, he has his plans in place, retirement age in place as well. What is your suggestion?
So good afternoon, Sonal, and it's lovely to be here today. Well, first thing, I really like the fact that at 28, he's kind of figured out that he wants to retire at 45. So I think, first of all, that's good that he's already started thinking about it, because most people do not start even planning for retirement till their 40s. Now, basically coming to the funds that he's talked about, and when you look at his retirement goal, and the sort of money that he's able to save for the period of time. So first thing is that it's a good amount that's getting invested, and you're really looking at building a corpus of about 6 to 7 crores by the time you retire, which is equivalent to about 2.5 crores today. Now, given the fact that he has a long-term holding, I would actually suggest more broad-based funds. So when I looked at the portfolio, of course, there are flexi-cap funds and there's a value fund, but I'm not too happy about the thematic funds, like, for example, the infrastructure and the reform fund or the non-cyclical consumer index fund. And one of the things that I don't like about themes and sectors is that they tend to be very, very concentrated. And in any case, the best stocks from these particular themes or sectors would be present in the broad-based funds, right? So one doesn't really need to take a concentrated exposure. And somewhere I believe that for the core portfolio and something that you're really looking for retirement, you actually need funds where you're just going to invest and possibly forget about it, right? So you don't want to get into funds which you have to track and where you have to take an active call to exit, and which is why I'm saying that please exit these sectoral or thematic funds, and maybe look at investing in more of mid caps, because of the fact that there is a long-term holding. He has specifically asked about mid-cap funds as well. So I would suggest either Kotak or Mirae mid-cap. And he could even look at adding some amount into small cap, since he does have like a 17-year time frame. And so he's at the right age. He has the risk-taking ability as well.
Okay, all right. That's a very helpful answer, Mrin. And, we'll be talking in greater detail about thematic funds during the later part of the show as well. But we have the next query, and it's on a call. Manoj Gupta is calling us. He's on the line from Noida. He has made investments in mutual funds and wants to invest another 2 crore rupees in next 2 years. Manoj, please go ahead. Tell us about your portfolio and 2 crore more for your retirement funds. Tell us more.
Yeah, actually, I have invested in the HDFC index fund, Nifty 50 index fund, 30 lakhs. I have invested Mirae assets, large and mid cap, 15 lakhs. I have invested Mirae asset, large cap, 10 lakhs. I have the Parag Parikh, 3 lakhs. I have the hybrid fund, ICICI equity and there, 10 lakhs. And I have the ICICI balance advantage, 6 lakhs. And HDFC balance advantage, 3 lakhs. And around 20 lakhs in the short-term funds, and 30 lakhs senior citizen saving scheme. Right now, it's a 1.5 crores corpus I have, and 2 crore corpus I have to receive for my provident fund, which I have to invest. My idea is to invest in the index fund, Parakparik Flexi Cap Fund, and Mrin Assets large and mid cap funds, and balance around 1.2 crore in short-term debt fund and arbitrage fund and Parakparik dynamic asset allocation fund, so that I can withdraw the fund through the SWP of 1.2 lakh per month.
Okay, all right. Mr. Gupta, thank you so much for actually providing all the details, because that helps our experts as well to give pointed answers as well. Mrin, what would you suggest should Mr. Gupta do?
All right. So specifically talking about the 1.2 crores that has to be used during retirement, right? So the point is that when you're looking at reinvesting the provident fund corpus, and somewhere I think he had also mentioned his expenses of 1.2 lakhs per month, right? So the best way to actually do it is through short duration debt funds. And the reason that I'm suggesting these and not suggesting a dynamic asset allocation fund or a conservative hybrid fund is because that element of equity that is there in those particular funds is going to make it volatile, and it's going to be very difficult to structure a fixed withdrawal every month in these cases, right? So you have more stability with the short duration debt funds than you have with any fund which has an equity exposure. And hence, because of that stability, you are sure that you're going to be able to withdraw that amount each and every month in the SWP, which may not be the case in case of the a balanced advantage or a conservative hybrid fund or any fund that has any equity exposure into it, right? So that's what I would say as far as the SWP is concerned.
Okay, all right. Take that point, and thank you, Mr. Gupta, for joining us on a call today with your query. Moving on now, Souvik Saha is writing to us from Mumbai. He's been investing 5,000 rupees in Quant Active Fund, 4,000 in Quant Mid Caps, 2,000 rupees in Parak Flexi Cap Fund. He says he wants to know whether his portfolio requires any changes or not. Actually, there are quite a lot of plans, or I would say funds in his portfolio. They will come up for you on the screen. A lot of exposure to Quant. There's SBI Long-Term Equity, ELSS as well, and the other names that will come. So let me come to you now, Mrin. What do you suggest? Because there are a lot of funds in the portfolio already.
Yeah, so first and foremost, honestly, nobody needs more than 5 to 6 funds in the portfolio. And remember, when you're looking at diversifying, you also need to diversify the style of management, right? So when you're investing with the same fund house, there is bound to be overlap of stocks. And when you look at, for example, Quant Active and Quant Midcap, you see an overlap of 41%. So 41% of the stocks are the same. Again, when you look at Quant Active and you look at Quant Small Cap, 33% of the stocks is the same, right? So certainly, I think some bit of consolidation needs to be done out there. Another fund that I would actually not recommend is the multi-asset fund. And the reason that I'm saying to exit this particular fund is really because when you already have a diversified portfolio, you really don't need a multi-asset fund in the portfolio, right? So what I would suggest is that look at exiting Quant Midcap and Quant Multi-Asset, and maybe just reallocate that among the PPFAS Flexi Cap and the Quant Small Cap, right? So just this bit of reallocation that needs to be done in the portfolio.
Okay, all right. So that point is right, that maybe you think that when you're investing in different funds, that is leading to diversification. But if it is in the same fund house, maybe not so much because of the overlap that Mrin just explained. Let's go across to the next query. Khalid writes to us from Mumbai. He's currently investing 3,50,000 per month via SIP route. He wants to know if these funds are right for a long-term perspective of 15 to 20 years and if his portfolio is well balanced. Now it's 3.5 lakh of SIP per year. I would really like to know what are the future plans here and what age he is at. But the funds are for you on the screen. Mrin, what is your suggestion here?
So I think he has a lot of work to be done because he's got 21 funds in the portfolio. That is just too many funds. Even for me to actually look through it, I was just wondering, oh my God, 21 funds, right? So this is just pure over diversification because the other thing that I noticed was that there is one fund in every category that there is, possibly, right? And I think he's been doing a lot of NFO investing because I see a lot of the factor-based index funds. So, like within the index fund space, you have the regular broad-based indices like Nifty 50, Nifty 150 mid cap, Nifty 250 small cap, right? You also have factor-based indices which use a factor, for example, like they focus on momentum or low volatility or value or quality, right? And he seems to have all of these things. I think other than quality, I think I saw every other factor that's possible, like even next 50 is there in the portfolio, right? Now I also see sector funds. So again, there's a sector fund, there's an infrastructure fund. I also see again a lot of exposure to quant funds, right? So again, the overlap issue that we've talked about in all the other cases. So, when you are constructing a mutual fund portfolio, you really don't need all these categories, right? I mean, just five simple categories: flexi cap, mid cap, small cap, maybe an ELSS fund, and of course, some debt funds is all that you need in the portfolio. You really don't need anything other than that. And again, having 21 funds, having various categories doesn't help you in increasing your returns, right? And this is just pure over diversification, right? So, when you're looking at these funds, and while a lot of these NFOs look very appealing, one of the things, most of them do come out with really nice presentations, which are available on their websites. And they do show you past performance or simulated performance. And it's always nice for you to actually check that, has the fund been able to, or the strategy, right? Has it actually been able to consistently outperform a simple Nifty 50, right? Now, if you're not seeing that, honestly, I don't see any reason to invest into it. So I would say certainly please exit from all of these factor-based funds that you've invested into. Maybe you could keep the next 50 index fund, but all this low volatility and quality and all of these funds, please exit and look at identifying a couple of funds in each of the categories, which is mid cap, small cap, flexi cap, and look at just reallocating into that. So that's already there in the portfolio. For example, I see Nippon India Fund, or for example, I see Quant Small Cap Fund that's there. I see Access Small Cap. So you already have a lot of small cap. Try to bring in some flexi cap, and maybe reallocate some into the mid cap fund as well. And that's about it. But just focus on having these three simple categories, and that should be good.
No, it's as important to know where not to invest as much as we want to know where to invest, right? Thank you, Mrin. This has been very helpful. Also because the number of schemes or number of funds in that portfolio was really huge. But we'll do one thing. It's a very interesting conversation. We'll take a quick break. On the other side, we'll come back with Mrin to answer all your individual queries. Welcome back. You're still tuned into MF Corner. We still have with us Mrin Agarwal to answer all your queries. Mrin, there are a lot of them. I don't know if we'll be able to cover all of them on the show today because they're such interesting ones. But let's talk about the next one. Smita Mohta is writing to us from New Delhi. She wants to know the ratios to check before she starts investing in any mutual fund, as well as their importance for an investor. I mean, we have spoken about it in great detail otherwise as well, but do you think there are any specifics that a new investor should definitely look at while investing in mutual funds?
Well, on the index fund side, there is a ratio known as a tracking error, which basically tracks how efficiently the index fund is, mirroring the index. And this information is available in all the fund fact sheets of the respective index funds, right? Now, when you're looking at other fund categories, specifically on the equity side, there are many ratios that we as advisors look at. And but in reality, these information is not really easily available in the public space. So while there is a ratio known as a Sharpe ratio, it gives you what is the risk-adjusted returns. So it's a measure of how well the fund is actually performing versus the risk-free returns. So that's one ratio that can be looked at, but it cannot be looked at individually and it cannot be looked at only for one time period. You always need to track these ratios over a period of time. And yes, the other thing that you of course need to look at when you are evaluating past performance is not to look at point-to-point returns, but to actually look at rolling returns. Because that gives you a better measure of what is the consistency of performance. So unfortunately, the information that we need to measure the consistency of past performance is not really available in the public space. And to that extent, investors will have to then look at especially those who are doing DIY investors would have to look at, sources or like, for example, Morningstar, which is a global leader for mutual fund research. That's one site that you could look at to do some and use some of the tools out there to compare the mutual funds.
Okay, all right. So if you're doing it yourself, there are a lot of publications available. Otherwise, you can always go ahead and speak to your wealth advisor as well. Let's talk about the next one. Samiksha writes to us from Chennai. She says she has a monthly SIP of 5,000 each running in DSP Index Fund, Invesco Large and Mid Cap Fund, SBI Large and Mid Cap Fund, and 2,500 rupees SIP in Mrin Asset Large and Mid Cap Fund. She's also invested a lump sum amount in Mrin PSU Bond Index Fund and a Sensex based index fund as well. She wants to know if her portfolio requires any changes. Yes, there's a lot of large cap, but there's debt fund, there's index fund. So it's a mixture of a lot of funds here.
Yeah, I think, as you said, the exposure to large cap stocks is very high because you have the large and mid cap funds, you've got the Sensex based index funds, you've got DSP index fund. I don't know which index fund she's referring to over there, but essentially the exposure to large cap stocks is extremely high. So I think some diversification is required. And it would be a good idea to look at consolidating, possibly, keeping the index fund, of course, keeping the debt fund, but really looking at consolidating these large and mid-cap funds maybe into more mid-cap funds, provided she can take the risk.
Okay, all right. So should have some exposure to mid-caps as well. Right now, it's a mixture of large and mid-cap funds over different funds as well. Okay, Mrin, let's move on to the next one. Aditya writes to us from Kerala. He asks if it is sufficient to have most of the allocation towards multi-asset fund if they are building a portfolio, or should one have different kinds of funds in their portfolio to talk about diversification, or at least diversification in their investments? What do you suggest?
Well, you could do either. Look, if you want to make it really easy for yourself and you feel that, okay, I just want to have a couple of multi-asset funds which take exposure to equities, bonds, gold, maybe some of them to real estate, maybe some of them to international equities, you could do so. The thing is that if you are looking at a multi-asset fund, please look through the fund very, very clearly to understand whether it suits with your risk profile. Now, this is because you have multi-asset funds today where some of them have only 35 to 50% exposure to equity. And there are others which have more than 65% exposure to equity, right? So, not all multi-asset funds are the same. You cannot assume that every multi-asset fund is going to have equal allocation to various asset classes. There is a different allocation, and also because of the different allocation that there is to the various asset classes, the taxation is going to be different. So, for example, it's only funds that have got above 65% in equities which are going to have equity taxation, right? Those between above 35% to 65% are going to have long-term capital gains after 3 years. So the taxation is also going to differ, right? So hence, please, understand where the fund invests and what is the sort of allocation and how are they allocating to the various asset classes before really choosing a multi-asset fund.
Okay, all right. Take that point, Mrin. Let's go across to the next one. Kavita Venu is writing to us from Chennai. She wants to know if she should invest in thematic funds as a first-time investor. She is a new investor and wants to know if manufacturing and defense themes are a good pick. Also because we've seen a lot of new NFOs in these two sectors itself, right? Mrin, what do you suggest?
This is absolute recency bias, right? Whatever we read about recently, we are going to invest. So, no, Kavita, I think as a first-time investor, please remember that whether you're a first-time investor or a regular investor, it's always good to be in broad-based, diversified funds, because what happens in thematic funds is that you end up being very concentrated in a particular theme or a particular set of stocks. And essentially, while we believe that there is, and if we actually believe that this theme is going to do well, then in any case, most of the, a lot of the high conviction stocks would be there in the broad-based fund. So you really don't need to take a concentrated exposure. The other thing also, with the themes is that the theme should actually play out. I mean, it could take much more time than anticipated. And this theme should be the theme should be able to play out for a long period of time. Again, all the companies, that the fund is having should actually benefit from this particular trend. And even though the theme might be great, like market returns may not follow. So classic example is of healthcare, where 2020, the healthcare stocks did well, but 21 and 22, they were at the bottom, right? So, and also when are you when are you entering into this theme? Maybe a lot of the returns have already come in this particular theme. So you don't know, whether there's enough value that's really left in this particular theme. So hence, I don't actually recommend any thematic or sectoral fund. I still think being a new investor, please start with a simple Nifty 50 index fund. There are a lot of them that are available. You could look at ICICI Nifty 50 index fund, for example, and start an investment there.
Okay, all right. And generally, all of you have been saying that if you're a new investor, it's very important to understand market cycles, the sectoral moves before investing there. So not really the best choice there, but your advice here has been really helpful. We do actually have some queries left, but no time left, Mrin. So we'll connect with you very soon and with more queries, more callers, more tweets about mutual funds because this investment has just been growing with now SIPs touching that 20,000 crore mark as well. Mrin, thank you so much today for joining us. Okay, all right. So with that, we'll do one thing. We'll take your leave on this edition of MF Corner today. Keep writing to us, keep sending us your queries, and we'll get them answered from our experts on the show. But right now, stay tuned for Closing Bell to take you through the last hour of trade.